moment to invest, you think you're being cautious. You think you're being responsible. You think you're playing it safe. You're not. You're choosing a guaranteed loss. And I can prove it with arithmetic so simple a teenager could understand it. Yet somehow very intelligent people miss this constantly. Let me show you the mathematics that nobody wants to face. If inflation runs at 3% annually, and that's the government's polite number, and your savings account pays you 0.5%, you're losing 2.5% of purchasing power every single year. That's not a possibility. That's not a risk. That's a mathematical certainty. Over 10 years, you will lose approximately 25% of what that money can actually buy. Not what the number says on your bank statement, not the nominal amount, but what it can purchase in the real world. And here's what's worse. Most people don't even realize it's happening. The number in their account stays the same or even grows slightly, so they feel secure. They feel safe. They feel like they're doing the right thing, but they're watching the wrong number entirely. You see, humans have a psychological flaw I've observed thousands of times. We measure what's easy to measure instead of what actually matters. We look at nominal dollars because we can see them clearly. We ignore purchasing power because it's abstract. It's like celebrating that your car's fuel gauge is working perfectly while completely ignoring that you're running out of fuel. The measurement device functions fine, but you're still going to end up stranded. Now, I know exactly what you're thinking right now. But Charlie, cash feels safe. I can see the balance. It doesn't fluctuate. It doesn't disappear overnight like stocks can. That feeling? That's your enemy. That feeling is costing you a fortune. We humans suffer from what I call deprival superreaction tendency. We hate losing what we have far more than we enjoy gaining something new. This bias is hardwired into us. It kept our ancestors alive when resources were scarce. But in modern financial markets, this ancient instinct destroys wealth. We're so terrified of a 20% drawdown in stocks, which historically always recovers, that we accept a guaranteed 30% loss over a decade from inflation. We pick certain loss to avoid possible loss. That's not rational. That's just expensive fear. Here's a mental model that has saved me from countless mistakes over 70 years. Always invert. Always think backwards. Instead of asking, what should I buy, ask, what are the ways I'm absolutely certain to lose? When you invert the cash question, the answer becomes blindingly obvious. Holding significant cash in an inflationary environment is voluntarily choosing certain loss over uncertain but historically probable gain. You're picking the guaranteed wrong answer because it feels comfortable in the moment. I learned this principle from studying physics, not economics. In physics, there's a concept called entropy. Everything naturally moves from order to disorder unless you add energy to the system. Cash purchasing power has entropy. It decays naturally, steadily, relentlessly, unless you do something about it. The second mental model you absolutely must understand is compound interest. Einstein supposedly called it the eighth wonder of the world, but he should have mentioned it cuts both ways. When inflation compounds at 3% and your returns are essentially zero, you're experiencing reverse compound interest. You're watching it destroy your wealth in slow motion. It's painless enough year to year that you don't notice the damage, but over decades it's absolutely devastating. Here's what people fundamentally misunderstand. They think volatility equals risk, but volatility is just movement. Real risk is the permanent loss of purchasing power. A diversified stock portfolio might decline 15% in a difficult year. That's volatility. But cash is guaranteed to lose 3% minimum every single year in purchasing power. That's permanent. You never recover it. Warren Buffett and I didn't build Berkshire Hathaway by holding cash. We held productive assets. Businesses that generate earnings, that can raise prices, that adapt to changing conditions. When we acquired See's Candies in 1972 for $25 million, people thought we dramatically overpaid. Every traditional metric said we were foolish. But See's had something cash will never have: pricing power. When costs increased, See's could raise prices. When inflation hit, See's adapted. The business was productive. Cash sitting in a bank account has zero pricing power. It has zero ability to adapt. It just sits there, slowly rotting in real terms, waiting for you to make a decision. Let me show you 5 assets that are genuinely safer than cash. Safer in the only way that actually matters: preserving and growing your real purchasing power. And I'll explain the mental models behind each one, so you can think for yourself instead of just memorizing what I say. The first asset is ownership in productive businesses. Most people call these stocks, though I prefer to think of them as what they really are: partial ownership in actual operating companies. Here's the crucial insight that most people miss entirely. A well-managed business with genuine pricing power naturally adjusts for inflation. It's built into the system. Think about Coca-Cola, which Berkshire owns substantial shares in. When inflation increases costs, Coca-Cola doesn't just sit passively losing value like a dollar bill does. The company raises prices, its earnings grow. The value of your ownership grows proportionally. Now, I'm not suggesting you buy just any stock. Most stocks are overpriced most of the time. Most investors are their own worst enemies, trading frantically and destroying returns through fees and terrible timing. But owning carefully selected pieces of exceptional businesses, companies with powerful brands, modest capital requirements, and genuine pricing power, is fundamentally different from holding cash. The mathematics are straightforward. Over the past century, stocks have returned approximately 10% annually on average. Inflation has averaged around 3%. That's a real return of 7%. Cash has returned essentially zero in real terms, often negative. But here's the critical caveat, and this is where most investment advice goes completely wrong. If you don't understand businesses, if you can't read a basic financial statement, if you panic and sell during inevitable downturns, then stocks aren't safer for you personally. You'll make them dangerous through your own behavior. This is about your circle of competence. You must know what you know. More importantly, you must know what you don't know. Never fool yourself about this. The second asset is productive real estate. Notice I said productive, not just any property, but property that generates actual income. A rental property throwing off monthly cash flow is a productive asset, exactly like a business. Real estate has several structural advantages in inflationary environments. Rents typically rise with general price levels. But if you have a mortgage, that debt payment stays fixed. You're effectively repaying it with cheaper and cheaper dollars over time. And the underlying asset often appreciates as construction costs increase. But again, and I cannot emphasize this enough, circle of competence matters enormously. Being a landlord requires work. It demands judgment, maintenance skills, tenant selection abilities. If you don't know what you're doing, you'll buy the wrong property at the wrong price in the wrong location, and you'll wonder why real estate doesn't work. Warren and I have owned substantial real estate through Berkshire over the decades, but always as productive assets. Buildings that businesses operate from. Land that serves genuine economic purposes. Never speculation. Always production based on real cash flows. Here's a simple test for any real estate investment. If the property stopped appreciating in value tomorrow, would you still want to own it based purely on the income it generates? If your honest answer is no, you're not investing. You're speculating. And speculation is just gambling with a more respectable name. The third asset is yourself, your skills, your earning power, your ability to create value in the marketplace. This is the one asset every person possesses, and it's criminally underinvested by most people. Benjamin Franklin understood this centuries ago. He said, "An investment in knowledge pays the best interest." Here's why this matters in a discussion about cash safety. If you have $50,000 sitting idle in a bank account and you're early in your career, you might be making a catastrophic mistake. That capital could fund education, professional training, starting a business, investments that could multiply your earning power 5 or 10 times over. I've watched people scrimp and save meticulously, proud of their growing cash balance, while their actual skills become obsolete. They're so focused on protecting what they have that they completely ignore opportunities to become more valuable. That's backwards thinking that guarantees mediocrity. Your total earning power is essentially the present value of all your future earnings, discounted back to today. If you can increase that by even 20% through better skills, you've created far more value than you could generate by investing that same money in any financial asset. And unlike stocks or real estate, your valuable skills cannot be taken away by market crashes or economic downturns. But, and this is absolutely critical, investing in yourself only works if you're brutally honest about what skills actually create real value. Learning obscure, unmarketable skills doesn't count. Learn skills that solve expensive problems for people with money. Skills that are genuinely difficult to replicate. Skills that match real market demand. I spent my entire life deliberately learning across multiple disciplines: law, mathematics, psychology, physics, business operations. Not to impress anyone, not to seem educated, but because solving genuinely complex problems requires tools from many different toolboxes. You cannot build a house with just a hammer. The fourth asset, and this surprises many people, is high-quality bonds in very specific situations. Notice I said high-quality and specific situations, not just any bonds. Certainly not most bonds in today's interest rate environment. Here's the mental model you need. A bond is fundamentally a promise to pay you specific money at specific future dates. The critical question is, what will that money actually be worth when you receive it? If you purchase a 30-year bond yielding 4% and inflation runs at 3%, you're barely maintaining purchasing power, and you've locked up your capital for 3 decades for that privilege. But short-term bonds from genuinely creditworthy issuers can serve a legitimate purpose. They're not there to make you wealthy. They're there to provide optionality, keeping your resources available for when genuine opportunities appear, while earning slightly more than pure cash. Warren frequently talks about Berkshire maintaining cash and cash equivalents, but notice he never keeps much relative to our size, usually just enough to meet known obligations and to seize opportunities when they arise. The bonds are temporary parking spots, not destinations. The mistake people make is treating bonds as safety when they're really just slightly less liquid cash. In genuinely high inflation environments, bonds can be equally dangerous as cash, sometimes more dangerous because they lock you in. Here's the rule. If a bond's yield doesn't meaningfully exceed your realistic expectation for inflation, you're volunteering to lose purchasing power in slow motion. At least with pure cash, you maintain liquidity. The fifth asset is genuinely useful hard assets, things that hold value because they provide real utility to humans, not just because we collectively agree they're valuable. This is completely different from speculation in gold or cryptocurrency, which I'll address momentarily. I'm talking about truly productive assets like farmland that grows food, machinery that generates income, even a reliable vehicle if it directly enables you to earn money. These are things that do something real, that serve actual functions. That would still matter even if the entire financial system had a heart attack. Now let me be extremely clear about gold because many people think it's the obvious answer to inflation. Gold just sits there. It produces nothing. It generates zero earnings. It cannot adapt to changing conditions. You buy it hoping desperately that someone will pay you more for it later. That's not investing by any definition I recognize. That's speculation with an ancient pedigree. Warren jokes that if you took all the gold ever mined in human history and formed it into a single cube, that cube would measure approximately 67 feet on each side. and it would sit there producing absolutely nothing except requiring security guards. Meanwhile, with the same amount of money spent on all that gold, you could purchase thousands of productive businesses generating billions in actual earnings every year. Which sounds more intelligent to you? Hard assets only make rational sense if they're genuinely productive. A farm that actually grows crops people eat, not farmland you're hoping to flip to a greater fool. Tools that enable you to build valuable things, not collectibles you're praying will appreciate. Function over hope, always. The common thread connecting all 5 assets is this: they do something real. Businesses produce goods and services people want. Real estate houses people. Skills enable you to create value. Even bonds, when chosen carefully, provide valuable optionality. They're active, not passive. Cash is purely passive. It sits motionless, slowly deteriorating in real terms, waiting for you to make an actual decision. The question isn't whether cash has any role. Of course it does, for genuine near-term needs and maintaining flexibility for opportunities. The question is whether it deserves to be your primary strategy, your foundation, your safe harbor. And the mathematical answer is absolutely not. Now let's discuss why intelligent people keep making this expensive mistake. Because understanding the psychology is crucial. It's not stupidity. Some extremely intelligent people are terrible with money. It's predictable patterns of human misjudgment that affect everyone. First, there's social proof tendency. Everyone you know keeps substantial money in the bank. Your parents did it, your colleagues do it. It feels like the responsible adult thing to do, so you do it too, without ever examining whether it actually makes logical sense in your specific situation. But just because everyone does something doesn't make it correct. In Weimar Germany, people who kept their life savings in cash were completely wiped out. The socially normal behavior was also the financially catastrophic behavior. Social proof is a terrible way to make important financial decisions. Second, there's availability bias. The pain of losing money in a dramatic market crash is vivid and memorable. It's on the news constantly. People discuss it. The stories stick in your mind with emotional force. The quiet, invisible erosion of inflation is abstract and boring. So you fear the vivid wrong thing while ignoring the boring, dangerous thing. You can easily see a stock portfolio drop 20% in a terrible year. You cannot easily visualize your purchasing power declining 3% annually for a decade. But the second loss is actually worse. It's 30% and permanent. The first loss is temporary and historically always recovers. Your brain is lying to you about which is more dangerous. Third is deprival superreaction tendency, which I mentioned earlier. We hate losing what we currently have so intensely that we'll do completely irrational things to avoid the feeling of loss. Even if it means accepting certain loss to avoid uncertain loss, even when the math clearly shows we're making ourselves poorer. The solution isn't to somehow eliminate these psychological tendencies. You can't. You're human. You'll always feel them. The solution is to recognize they exist, name them when you catch yourself feeling them, and build systematic processes that protect you from your own predictable psychology. Here's my personal system which you can adapt. I decided long ago, based on rational analysis, not emotion, what percentage of assets should be in different categories. Then I stick to it. I rebalance when necessary. I don't check prices daily. I don't let temporary fear or greed change the fundamental plan. This isn't exciting advice. It's profoundly boring, actually. But boring and rational beats exciting and emotional over any meaningful time period. The tortoise beats the hare not because he's faster, but because he doesn't sprint in random wrong directions. Let me give you a practical framework for thinking about your own situation. I cannot tell you exactly what to do. I don't know your circumstances, knowledge, or temperament. But I can give you the right questions to ask yourself. First question, what is my genuine circle of competence? What do I actually understand deeply? If you understand businesses, perhaps you should hold mostly carefully selected stocks. If you understand real estate thoroughly, perhaps that's your primary focus. If you don't truly understand either, perhaps you focus on low-cost index funds while simultaneously developing your earning skills. Second question, what is my real risk? Not the volatility I see on a screen that makes me emotionally uncomfortable, but the actual chance I won't have sufficient purchasing power to live the life I want. For most people, the true risk is inflation steadily destroying their savings, not temporary market volatility. Third question, what is my honest time horizon? If you genuinely need money in 6 months, fine, keep it in cash. You have no choice. But if you don't need it for 10 years, why would you voluntarily choose an asset guaranteed to lose significant value over that period? Fourth question, what are the second-order consequences? This is where most people stop thinking far too early. They think cash is safe and stop analyzing. But the second-order consequence of safe cash is inadequate retirement, reduced life options, working much longer than you want to. Fifth question, what does inversion tell me? If I hold mostly cash for the next 20 years, what's the highly probable outcome? Can I honestly accept that outcome? If not, what should I change today? These aren't rhetorical questions meant to sound wise. Actually, write down your specific answers. You'll be shocked by how much clarity emerges from simply thinking systematically on paper. Most people never do this basic exercise. They just react emotionally day by day and hope things work out. Now here's something uncomfortable that needs to be said directly. The reason most people stay financially mediocre isn't lack of opportunity. It's lack of rationality. They make emotional decisions. They follow crowds blindly. They avoid looking at simple mathematics. Then they wonder why their financial situation never meaningfully improves. You cannot think yourself wealthy through positive thinking or affirmations or any of that fashionable nonsense. But you can absolutely think yourself